Let's look at the data. Right now, a battle is brewing in the market, and your access to information is right there on the front line. On one hand, you have retail investors demanding more transparency than ever before. But on the other, a new SEC proposal could plunge a huge portion of the market into darkness. This is the information war, and believe me, the outcome is going to directly impact your edge.
And this really gets to the heart of it, doesn't it? Is the golden age of retail data, the very thing that fueled so much of the recent retail movement, is that coming to an end? This is a divergence that absolutely demands our full attention.
So let's start by outlining the two opposing forces in this conflict. It's absolutely crucial to understand both sides of this battlefield, because that's where you're going to find the opportunities. On one side, you've got retail. But look, this isn't 2019 anymore. This is a much more organized, sophisticated, and data-driven retail investor base than we have ever seen. You have groups like We the Investors building their own tools and demanding access to the same institutional-grade data that the big funds use. They're organized, and they are not quiet about it.
Now, on the other side, you have this proposed rule from the SEC, and get this. It would raise the 13F reporting threshold for institutional managers from $100 million all the way up to $3.5 billion. That is a 35-fold increase. A change that would effectively make thousands of smaller and mid-sized fund managers just invisible to the public.
So the SEC's official line is that this change still captures over 90% of the dollar value of all reported assets. The idea is to focus only on the biggest players with market-moving potential. But the critical question we have to ask is, what are we losing in that other 10%? What's hiding in there?
To really get the impact here, we need to decode the data that's at the very heart of this conflict. So let's break down what's been in the retail trader's arsenal up to this point. First step, Form 13F. For years, this has been a primary weapon. It's that quarterly snapshot that shows us what large funds are holding. Now, it's not perfect, it's delayed, it only shows long positions, but it provides a really critical window into institutional flows and where they're putting their money with conviction. The second key data point is, of course, short interest. This metric helps us identify stocks that are heavily bet against by institutions, and when that short interest gets extremely high, it can create what we call a coiled spring effect. You know, a setup where any significant buying pressure could trigger a rapid, explosive price move to the upside, what we all know as a short squeeze. And this right here brilliantly illustrates the power of combining these data points. That Kohl's rally back in 2025? A classic example. The stock had enormous short interest, a fact that was visible to anyone who was watching the data. This high short interest signaled a huge vulnerability, a potential squeeze setup, and retail traders saw it and capitalized on it. Okay, so let's analyze our counterparty. And it's important to be objective here. This is not about good guys and bad guys. It's about understanding how large institutions rationally operate to protect their strategies in a very, very competitive environment. Institutions just have structural advantages. They operate in ways that aren't fully captured by standard disclosures like the 13F. They use complex derivatives, we're talking options and total return swaps, to build positions without ever showing up on the radar. They use less transparent dark pools for trading massive blocks of shares. And yeah, they exploit loopholes like the bona fide market-making exception. All of this combines to create a natural information asymmetry. And the crucial point is that this opacity, this lack of light, has very real-world consequences. I mean, the catastrophic collapse of Archegos Capital is the prime example. They used undisclosed swaps to build these enormous leveraged positions. When those bets went south, the fallout just cascaded across the market, causing billions in losses. More transparency might have actually prevented that.
So, if the traditional data sources like the 13F are becoming less reliable, or at least less comprehensive, how does the agile retail trader adapt? The game is not over, it's just changing.
So here's a balanced look at the strategic situation. The bull case? Retail adapts. New tools, new alternative data sources emerge, and volatility creates opportunities for those who are nimble. The bear case, on the other hand, is that the information gap widens. Especially in small-cap stocks where these smaller funds are more active, that makes it a lot harder to track institutional flows in those specific names.
But here's the thing. That adaptation, it's already happening. New research is proving that unconventional data sources, like analyzing social media sentiment on platforms like Reddit, can be a viable tool for generating alpha. So as one door closes, another one opens. Retail is evolving from just tracking filings to tracking real-time sentiment.
So what's the takeaway from all this? The market structure is in flux. The information edge is shifting. The strategy now has to be to remain data dependent, to manage your risk rigorously, and above all, to adapt. The core principles haven't changed. Stay disciplined, stay liquid.
And a quick but really important note here. This analysis is for educational purposes only. It's based on data that's current right now, and as we've just discussed, this stuff changes incredibly fast. So as always, please do your own due diligence.
We are tracking these flows in real time. So while you analyze the next move, you should check out the tools we've got in the description. You can sign up for Public to get $20 in free assets, check Webull for that BTC promo, or look into NVDI over on Moomoo. All the links are right down below. And hey, if you got something out of this, like and subscribe for more deep dive analysis.